Hey, MCE crew, I hope your day is progressing profitably. Got a little glare, please forgive me for that. But the sun is in full bloom. It's about 100 degrees here right now. So, in any event, let's get right to it. We're going to talk about the economic recovery, and we're going to examine it to see whether or not we are in an actual recovery. Remember, you've got to be very careful about what comes out of our government and the media. They lie. Okay, I'm not even going to say they don't tell the truth. They lie. They flat out lie. They enjoy it because lying helps them confuse situations and maintain ratings and power. So we're going to compare what's going on out there to 2008, the Great Recession, and see where we are. Now, a lot of what we're going to take a look at is artificially induced, okay? And that was caused by the shutdowns. Governors shutting down their states have created all types of ramifications from, of course, the unemployment situation to supply chain problems and everything in between. But what we're going to do is we're going to take an opportunity to look at this. And then, as always, we're going to talk about how to profit from it. All right. So let's start out talking about unemployment. Now, according to the Bureau of Labor Statistics, and listen, I'm going to link to all of this. There are going to be a lot of links so that you can do the research as well. Remember, I always say, don't just trust someone in the screen. You've got to educate yourself as well. And we're going through this exercise because this is what I do on a regular basis. I do not watch the news, okay? I don't do it. It's just fake and phony. All of it, okay? Every channel, as far as I'm concerned. So I actually do my own financial research and rely on a lot of the folks here on YouTube. Be they commenters, like we got a gentleman, Alex, that has worked with us here lately and discovered some things that I was unaware of. And he's one of our subscribers, one of our viewers. We really appreciate it. That's the kind of community we're trying to grow here. So this is the process that I engage in to enlighten me as to really what's going on financially. So let's take a look at the fact that non-farm payrolls shed 22.1 million jobs between January 2021 and April 20th. And that happened, of course, we know why, because the economy, the society by and large, shut down. So there's been a lot of hay made about, oh, we're adding jobs. You know, you see certain politicians crowing about that. But in fact, we're replacing jobs that were lost. We have not replaced 22.1 million jobs, however. We're still in a deficit. Now, look, I'm not doing the esoteric Harvard and Yale math. I'm just doing regular math, okay? No Common Core stuff. Just taking the unemployment real number that was filed in the Bureau of Labor Statistics for each month starting in May of 2020. Because again, we said between January and April, we lost 22.1 million jobs. Now, when you add that up, you get a total of 15 million in terms of jobs we've added since May of 2020. When we add each month up, we get a total of 15,836,000 jobs. Okay, and that's not 22.1 million. So that's the first lie that we've exposed. The employment situation is, in fact, doing okay from the standpoint of replacing the 22.1 million. But until we get beyond 22.1 million jobs, then we can't say we're adding jobs. We're replacing jobs that were artificially taken out of the economy due to government action. So we've still got roughly 6.3 million jobs to go before we can honestly say we're adding jobs. Now, for some context, U.S. employers shed 2.6 million jobs in 2008. Now, that was, really the beginning of the Great Recession. That was the first full year of the Great Recession, started in December of 2007. So we're beyond that 2008 number right now. What are some risks that could occur to, really stymie employment going from where we are right now? Well, of course, if we look at other iterations of a certain illness, of course, if we go back into a situation where there are shutdowns, that could impact employment. So we just got to watch that. Now, we're going to move on to another indicator, which is Wells Fargo here. We did the video about Wells Fargo shutting off lines of credit, all right, consumer lines of credit. Now, we saw this same thing occur with a lot of the banks back in during the beginning of the Great Recession, 2008. A lot of banks went in and they cut off consumer credit, cut off credit cards, or decreased the limits, got rid of lines of credit, just like Wells Fargo has done. Now, this could be indicative of a great degree of concern by the banks that we're sailing into some rough waters here. Now, the banks definitely expect us to hit inflation, because JP Morgan has been really upfront about saying, look, we're hoarding cash. Now, they're hoarding cash because they want to be able to pounce. This is what Jamie Dimon said. They want to be able to pounce on assets and purchase them when things get cheap, okay, when assets get less expensive, brought to you by some recessionary period. So keep that in mind. Look at what the banks are doing. Look at how they're behaving. And that should give you some indication of how you need to roll as well. Now, look, when we talk about cash, understand JP Morgan is not just, taking a bunch of cash and putting it under a pillow. Okay, what they're doing is they're putting that into vehicles that is allowing them to protect that cash from inflation. And we talked about bank-owned life insurance. You can bet your bottom dollar that JP Morgan is buying up a lot of bank-owned life insurance, because the dividend on that is going to help them stay in front of inflation and keep the value of that money that they are storing up. Now, here's another number. Inflation in 2008 was 3.8%. Right now, for the 12 months ending, May 2021, we ended at 5% inflation. Okay, so our inflation number is actually higher than it was for that first full year of the Great Recession. And again, with the actions of JP Morgan, what's been coming out of the Fed, we see that the video we did previously talking about how these economists expect inflation to remain here for a while. Jamie Dimon, CEO of JP Morgan, has said that he sees it lasting in perpetuity. So that's another. Things are getting more expensive, putting more pressure on the consumer. And remember, this is a consumer economy. Okay, finally, let's get into a discussion about foreclosures. Now, in 2008, we saw a total of 3.1 million foreclosures. Now, during this whole, issue that we've gone through here in the last 18 months or so, we've seen a total of 7.2 million homeowners enter forbearance. Now, forbearance is that workout arrangement where your mortgage service provider is saying, all right, we're not going to foreclose. We're going to make an arrangement with you. We're going to maybe put some payments on the back of the loan. We're going to try to work this out because we know that the situation is not of your doing. Now, a portion of those borrowers, those mortgage holders, own rental property. And so we know that they haven't been able to collect rent in many instances because of the states also have the rental moratoriums. Many of the states have a mortgage moratorium as well. So the good news is, out of that 7.2 million, let's see, I want to be accurate here. Only 2 million remain in forbearance. So we've got over 5 million people that have come out of forbearance and are paying their mortgage as per usual at this point. Hopefully that number will continue to drop and we won't see a rash of foreclosures here. But just for some context, again, there were 3.1 million foreclosures filed in 2008, and right now we're sitting on 2 million more forbearances, or 2 million forbearances. So the good news is we're below that 3 million. And hopefully, again, we can process these out and these people won't face foreclosure for something that was not even their fault in the beginning. Okay, you can't collect rent or you can't pay your mortgage because your business or your job has closed. Then what are you supposed to do? And it's no for the government did this. Okay, not not any company, not any individual. Okay, so those are just some factual, actual, non-political, non-agenda driven views at some of the major things that are going on in our economy. Now, we talked about the inflation piece. We talk about it a lot. You need to get your money working harder for you. If your money is not making 5%, because we already talked about the inflation rate being 5% for that 12-month period ending in May. If your money didn't make 5% over that period, at least, then you got poorer. You lost value on your money. So you've got to take care of that. We have discussed ad nauseum on this channel various ways for you to improve the return on your money. One thing I want to go over with regard to real estate. Now, I've said many times on the channel that you should not pay your house off. And the reason you should not do that is because you take away a large degree of financial flexibility when you do that. When your equity is locked in home and you can't get it unless a bank approves a HELOC loan or unless someone comes along and agrees to buy your home, that has, stifled your financial flexibility. However, you should have the ability to pay off that mortgage if you need to. So that should be a part of that opportunity fund phase 2, when you're really getting that money working. But as it's working, it has as one of its purposes the safety valve of being able to either pay the mortgage off in full or to be able to preferably to pay the mortgage monthly payments, okay, or get slightly ahead so you don't have to be under a lot of financial pressure. Now, we also talked about the job situation. Now, when that 22 million was laid off, they had no control over the situation, none whatsoever. They were just given a notice that they were being laid off or fired or what have you, okay? So I'm going to go back and advocate again for business ownership. Now, there are no guarantees in this world, so there's nothing guaranteeing that if you open a business, it's going to be wildly successful. No, that's just not how our life in this universe works. However, you will have much more control over your destiny than the individuals, unfortunately, who were laid off. But to give you some context and to be fair about it, I've had like 3 or 4 of my most favorite restaurants, independent small businesses, close. So that's done, over with. So as you look to establish a business here, post 2020, you have to have something that is going to be fit for the long run. Now, I'm partial to the financial services industry and to the real estate industry. Okay, you know that. And we welcome anybody who wants to talk about those industries to have a conversation with us. But if you are going to thrive the remainder of this 21st century, and you're going to have more control, you want more control over your finances, you're going to need to found your own business. And who's to say you have to leave the job that you're working at? No one's saying that. But you will add an extra layer of control with regard to your finances if you open your own business and go pursue that 100% of the time, or you get some sort of I hate the term side hustle, or some sort of business that you can pursue in your part-time, or maybe your spouse can pursue that, or maybe your kids can pursue that. So we talk about economic independence, and a job will not get you there most of the time, okay? A job cannot guarantee you stability. That's just not how the W-2 world works. It's not supposed to, all right? So this is, it for today. One that last note in terms of a job providing you with complete financial independence. Take a look at our video on the 401k not being enough, all right? A lot of people that are working jobs are in the 401k, and they think that that's it. That's all they need to do. And they're going to find out if they pursue that, it's not enough. It's not enough to achieve financial independence. So enough for today, guys. I'll talk to you soon.